We just saw the biggest rate hike from the Fed in decades. So what's it all mean?
You're definitely going to want to watch this one.
So we know that last week was the biggest rate hike by the Federal Reserve in decades, raising the key interest rate 0.5%. And here's the thing about this rate hike. It was expected. If you looked at what happened immediately after the meeting, the stock market rallied. Now, the stock market's a little all over the place right now. It's a little volatile. And that's because people are starting to become uncertain about the economy. Because we're seeing this rate hike by the Fed. The Fed is trying to battle inflation. Inflation is the enemy of long-term interest rates, according to David Childers from Keeping Current Matters. And we saw inflation peak at 8.5% in March, and that was the highest since December of 1981. So we're seeing things start to happen that have not been the trajectory of the economy, and the Fed's reacting because that's their job. So knowing all of this, what does this mean for the market? Well, we've already seen that mortgage rates kind of anticipated this raise by the Fed, so they didn't really change too much. They kind of stayed where they were because it was expected. The Fed was very clear at their last meeting they were going to raise rates all throughout the year, and they did it again. So what we're seeing now is that rates are in the mid 5% range. Affordability has gone down. The cost of money has gone up for people in the housing market, and inflation continues to be an issue. That's what the Fed is battling right now. So if you're selling or buying, here's what you need to know. If I'm a seller right now, I'm looking at this and realizing that my buyer pool went from this to this over the past couple months. I mean, it's shrunk down over the past couple months because people that could afford your home at its current value at 3.25%, some of them won't be able to afford your home at 5.5% just based on debt to income ratio and what kind of payment they can afford on a monthly basis. And this is likely going to continue. So what I know is that the demand is still really strong right now. There's still people out there that haven't been able to find houses. That stems from back to 2020 and when the pandemic hit in March of 2020 up until now. So knowing that you still have demand, because ultimately it's a supply and demand issue in the market, supply is still low, demand is very strong. If I'm a seller, I want to take advantage of the demand because the low rates are gone. That's in the rearview mirror. So if I was thinking about selling next year or in the next 6 months, I'd be looking at how do I transact now? How do I move my time frame up to take advantage of the demand, because we're still seeing multiple offers, inspections getting waived, all those terms that only really materialize in the most seller-friendly market I've seen in the past 21 years. So that's what I would be doing if I was a seller. I'm moving up my time frame if I have the intention of moving, period. Now, if you're a buyer, here's the thing you got to think about. Prices aren't projected to go down because rates have gone up. You look at all the people out there that predict these things. Keeping Current Matters usually tabulates the top 7 housing indexes like Zillow, Fannie Mae, all these places that are paid to make predictions, and nobody is predicting prices are going to go down. And if rates continue to climb, well, when rates climb, your payment goes up, prices are predicted to go up, you're still going to be chasing down the market. So I'd be looking at finding something now and getting that automatic equity buildup because prices are projected to go up anywhere from 6 to 17% this year. I'm imagining it's going to be somewhere in that 8 to 10% range based on what we're seeing here locally in the greater Philadelphia area. I want to take advantage of that appreciation. I want to take advantage of getting the hassle of moving over with so that I'm not worried about this when the economy's a little more fragile. Because if payments go up and prices go up, it's going to cost you more money. So there is a legitimate cost to waiting if you're on the fence right now. So the message here is this: if you've got motivation, if you're thinking about making a move, this move by the Fed reinforces that the people that get ahead of this market shift, because that's what I'm clear right at the very beginning of right now, are going to be the ones that win financially long term. Obviously, every situation is different, so if you got questions, you need anything, you know where to reach us.